Hi everyone, welcome back to our MCQ Marathon playlist where we help you crack the audit code with questions for board exam preparation. And who would have guessed we are already starting our round three of our multiple choice question preparations. And same as usual, we're going to divide our 100 questions per round into 25 questions with just one goal, CPA success. Let's start with round three, part one. Our first question asks, in a financial statement audit risk represents the probability that letter A, inherent and control risk cause misstatements that could be material to the financial statements. And actually, letter A is the risk of material misstatement. It is not audit risk. So the answer is not A. Letter B, the auditor is not retained to conduct a financial statement audit in the succeeding year, which may be a business risk to the auditor but is not audit risk. Letter C, the auditor unknowingly fails to modify an opinion on materially misstated financial statements. And ding, 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 the answer is letter C. This is the very definition of audit risk, when the auditor fails to modify an opinion on materially misstated financial statements. Letter D, on the other hand, where the system of internal control fails to prevent or detect a material misstatement from entering the financial statements, this is control risk. So the answer to the first question is Charlie. Next, as the acceptable level of detection risk decreases, an auditor may change and to this we do recall the audit risk model where we say the audit risk is equal to the risk of material misstatement multiplied by the acceptable level of detection risk, and where we point out that the acceptable level of detection risk is the only risk controllable by the auditor. That's why we call it acceptable level. It denotes the ability of the auditor to control detection risk, and the auditor controls the response to the acceptable level of detection risk by looking at nature, timing, and extent of audit procedures. Now, we are also saying that the acceptable level of detection risk has an inverse relationship to audit effort. Therefore, when the auditor sets the acceptable level of detection risk at a low level, when the auditor decreases the acceptable level of detection risk, the auditor actually increases audit effort. And when the auditor increases audit effort, this is one way of the auditor to say that the auditor is imbibing or having a strict state. Okay, so because we are looking for a decrease in detection risk, we're going to look for the strict auditor. We're looking for the stricter auditor. Letter A, nature of substantive test from less effective to a more effective procedure. And this one most definitely gives us the personality of a strict auditor, right? Say, for example, choosing between simply asking for a certification of cash versus actually counting the cash. So the auditor is stricter that way. So letter A then is our answer for this question. However, let's still evaluate the other choices. Letter B, timing of substantive tests by performing them at interim rather than at year end is actually the mark of a chill auditor, because the auditor does not test the entire period under audit. So the answer then is not B. Assessed level of inherent risk to a higher amount, we do have to take note that inherent risk is non-controllable by the auditor. And so therefore, we do not respond to our acceptable level of detection risk by adjusting inherent risk, because inherent risk is not controllable. Letter D, timing of tests of controls are performing at several dates rather than at one time is also not necessarily a mark of a strict auditor. Then we talk about nature, timing, and extent. When we talk about nature, it's actually letter A, performing tests, choosing procedures that are more effective instead of less effective. That's how an auditor becomes strict. In terms of timing, then performing procedures as close to the balance sheet date as possible or covering the entire period under audit rather than an interim basis. And in terms of extent, using a larger sample size. Okay, those are the marks of a strict auditor. So the answer to this is alpha. Next, which of the following is the least persuasive type of audit evidence? And to this, we recall the hierarchy of audit evidence reliability, where we said externally generated documents are more reliable than internally generated ones. Those which are obtained from written evidence are more reliable than verbal or oral evidence. And of course, as well as those which the auditor has directly obtained is more reliable than that the auditor got from inference only. So which of the following is the least persuasive type of evidence? Letter A, documents mailed by outsiders to the auditor, so external sources. Letter B, copies of sales invoices inspected by the auditor. Letter C, computations made by the auditor, so direct. Letter D, correspondence between the auditor and the client's attorney. So amongst the four, there is one here that is least persuasive. We're not saying it's not persuasive, only that when compared with all the others, it is the least persuasive, and that is, of course, Bravo. Mainly because sales invoices are internally generated documents. Okay, so I mean to say in this case, the client is the seller. That's why the client prepares the sales invoice, and so therefore these are internally generated documents. When compared with all the others, this becomes the least persuasive. Let us now proceed to the next question, and this one delves a little bit into the concepts of audit sampling. So, in deciding upon the acceptable risk of incorrect acceptance, and let's stop for a while and let's try to recall that the acceptable risk of incorrect acceptance, or ARIA, is actually one of the super twins. We have ARIA and ARO, acceptable risk of incorrect acceptance and acceptable risk of over reliance. Both of these represent the type 2 risk in audit sampling. And we know that type 2 risks, they tend to affect the auditor's effectiveness. And so therefore, this is the scarier type of risk. And because the auditor is scared of the type 2 risk, the auditor endeavors to control the type 2 risk. That's why we call it the acceptable risk of incorrect acceptance or acceptable risk of over reliance. So, in deciding upon the acceptable risk of incorrect acceptance for an account, an auditor considers each of the following except. We have letter A, audit risk. Letter B, the risk that internal controls fail to detect material misstatements that have occurred, or in other words, control risk. Letter C, tolerable error. Or letter D, the risk that analytical procedures and other tests fail to detect material errors that occur and that are not detected by internal controls. So we do remember that when we talk about ARIA, or acceptable risk of incorrect acceptance, this is representative of the type 2 risk of substantive tests. And so therefore, of the four, the one that we will not consider is actually tolerable error. Our determination of area or type 2 risk will eventually affect our determination of our tolerable error or tolerable misstatement as well. But it is not the case that tolerable error will be plugged in the determination of area. So area affects later on our determination of our tolerable error. And so therefore, these two are separate concepts and will separately be considered. So the answer is Charlie. Next, which of the following situations would most likely require special audit planning by the auditor? Letter A, assets costing less than 500 are expensed even though their expected life exceeds 1 year. And actually, letter A may be considered as a common practice. We do have, or businesses do have, what is called a capitalization policy, whereby businesses set a threshold for purchases that will or that may qualify to be recorded as an asset. So purchases below the threshold set may be recognized as expenses. Letter B, some items of factory and equipment do not bear identification numbers, and while letter B represents a control weakness, this does not necessarily require special audit planning. Letter C, depreciation methods used on the client's tax return differ from those used on the books, and again, this is something that the auditor expects to reconcile and does not require special audit planning. The answer, therefore, is letter D, where inventory comprises precious stones, because the valuation of these stones, gems, and maybe other important metals are beyond the auditor's expertise. So, letter D definitely would require the use of special audit planning and maybe even the presence of an expert. So, Delta is the answer to this question. So let's now visit RA 9298, or the Philippine Accountancy Act of 2004. Which of the following does not constitute a practice of accountancy? Take note again, we're looking for the one which does not constitute a practice of accountancy. Letter A person representing his or her employer before government agencies on tax and other accounting related matters is actually a practice of accountancy in the commerce and industry sector. Choice B, on the other hand, says a person holding himself out as one skilled in the knowledge, science, and practice of accounting and as a qualified person to render professional services as a CPA to more than one client. And because this CPA is serving more than one client, then this is a CPA in public practice. Letter C, a person in education in an educational institution teaching accounting, auditing, business law, taxation, or other technically related subjects is of course a CPA in education. Letter D, a person is appointed as a marketing director of a government-owned and controlled corporation is the exception. This is not considered as a practice of accountancy as the position being occupied by this person is not necessarily related to the accounting field or the accounting discipline. So the answer is delta. Next, let's talk about when performing trend analysis. And trend analysis is one of those analysis that we can perform when we have analytical procedures. So when we perform trend analysis, letter A, comparison to budget may be performed. Letter B, solvency ratios are computed. Letter C, expected values are calculated. Or letter D, profitability ratios are required. And while the computation of ratios may also form part of our analytical procedures, the performance of a trend analysis would normally or usually involve comparison to budget to determine whether the trend is somehow being able or is able to meet or is showing the entity or the company's ability to meet the targets or the budget. And so therefore the answer to this is alpha. Next, the auditor's main purpose for the consideration of internal controls for a non-SEC client is to. And before we evaluate the choices, let's point out why this question specifically makes reference to a non-SEC client. Okay, so in the Philippines, whether the client is listed or not, ergo whether the client is non-SEC or SEC, it doesn't actually, there's no difference in terms of the consideration of internal controls because in the Philippines, we do not give an opinion on internal controls. Okay, so whether SEC or non-SEC, we do not give an opinion on internal controls. However, for some other jurisdictions and some other countries, like the US, for example, where there is the presence of an integrated audit, the moment the client is a public entity, publicly listed entity, then the auditor performs an integrated audit which involves both an opinion on the financial statements and an opinion on the internal controls. Okay, so since we are in the Philippines, whether it's SEC or non-SEC, or since these questions are framed from the Philippine context, whether SEC or non-SEC, it actually doesn't matter. Okay, so what is the purpose of our consideration of internal controls? Letter A, develop suggestions for improvements in internal control. Letter B, determine the nature, timing, and extent of our substantive testing. Letter C, express an opinion on the financial statements. Or letter D, determine whether fraud has occurred during the year under audit. And to this, we are reminded when we consider the internal controls of our client, we are actually performing risk assessment procedures where we obtain an understanding of the client's internal controls. Okay, and the main purpose for doing that is so that we can eventually have an assessment for the risk of material misstatement, which includes control risk, so that eventually we will be able to decide on the nature, timing, and extent of our substantive testing. This is in the true audit risk model fashion, right? Where we have RMM, or the risk of material misstatement, times the acceptable level of detection risk. So our understanding of internal controls falls within the assessment of the risk of material misstatement. What is the purpose? So that eventually we can decide on our acceptable level of detection risk, aka our response to it as well, which is through the nature, timing, and extent of substantive testing. Let us go back to RA 9298 or the Philippine Accountancy Act of 2004. The question is, the Board of Accountancy may issue certificate of registration and professional identification card to any successful examinee, letter A, guilty of immoral or dishonorable conduct, letter B, unsound mind, letter C, who has falsely represented himself in his application for examination, or letter D, convicted by a court of political offense. To this, we do recall example, the reasons for either withholding or refusing to issue the certificate of registration, okay, or revoking the said certificate of registration, we go by the mnemonic ICU. In the case of immoral and dishonorable conduct, letter I. Letter C is for crimes involving moral turpitude. Letter U, of course, is unsound mind. So the one that is not included is letter D. Conviction of a political offense is not considered a disqualification from the license. So the answer to this is delta. Next, an independent audit report. Letter A confirms the accuracy of management statements. Letter B guarantees the financial statements are accurate. Letter C provides written assurance that the financial statements are fairly presented. Or letter D assures the readers of financial statements that any fraudulent activity has been corrected. Now, we know that the level of assurance we're able to provide when we give our audit opinion is a reasonable level of assurance. We do not guarantee, we do not certify, we do not assure that all fraud has been detected. Rather, our opinion simply provides written assurance that the financial statements are fairly presented. So, Charlie. Next, which of the following persons is not considered a specialist or an expert according to the standards? So we have to remember when we frame this question in the context of an external FS audit, a specialist or an expert is someone who specializes in fields other than accounting. Okay, so in this case, then an engineer is considered an expert, an appraiser is considered an expert, an actuary is considered an expert. These are fields beyond our accounting discipline, and so the one person here who is not a specialist is an internal auditor. Okay, so alpha. Next, in a financial statement audit, inherent risk represents, and we recall that inherent risk is the risk that is embedded in a nature, embedded, or it's the nature of the transaction, balance, or event. It's uncontrollable by the auditor, as well as we're talking about the very nature, okay, of a transaction, an account, or a balance, or an event. So inherent risk represents letter A, the risk that the auditor fails to modify materially misstated financial statements. And there's something wrong with letter A because it is not the responsibility of the auditor to modify the financial statements, as these are actually the responsibility of management. So it's not letter A. Letter B, the susceptibility of an account balance to a misstatement that could be material. Letter B may have a chance of being the correct answer, so let's leave that there. Letter C, the risk that misstatements could occur and not be prevented or detected by a system of internal control, that is control risk. Letter C is control risk. Letter D, the risk that misstatements could occur and not be detected by the auditor's procedures is detection risk. So inherent risk here is letter B. Now we have to remember as well that when we talk about inherent risk, we are assuming that no controls are in place. Okay, so the assumption is that no controls are in place. We're going to let the account, the transaction, or the balance behave in its natural habitat. Assuming there are no monitoring, there are no controls. That is inherent risk. So, bravo for this number. Next, an independent audit is important to readers of financial statements because it, letter A, provides a measure of management stewardship function. Letter B, reports on the accuracy of information in the financial statements. Letter C, measures and communicates the financial data included in the financial statements. Or letter D, objectively examines and reports on the fair presentation of the financial statements. And I think we are all able to spot the importance of independent audit, right? It objectively examines and reports on the fair presentation of the client's financial statements. We do not actually measure the stewardship function of management. We do not give an opinion as to whether management is doing the right thing or not. Okay, and again, we cannot report on the accuracy, as we all know that the financial statements themselves are not really accurate. Take, for example, or cite, for example, the presence of estimates, right? The measurement and communication of financial data is done in the accounting phase of it. So this is the role of management, not the auditor. So the answer to this is delta. Next, which of the following statements relating to the competence of evidential matter is always true? Now, whenever we talk about evidential matter or evidence, we always talk about the sufficiency and appropriateness of audit evidence. And we know sufficiency is quantity, appropriateness is quality, and quality is being represented by both relevance and reliability. When we talk about competence, we're actually referring to the quality, ergo the appropriateness of evidential matter. So, which of the following is always true? Letter A, properly designed analytical procedures will detect material misstatements. This is not always true, as analytics, being a study of the plausible relationships, can only raise red flags or could show us some unusual relationships, but they do not always detect material misstatements, as these red flags or unusual relationships might actually contain some very valid reasons, right? So it's not letter A. Letter B, evidence gathered by auditors must be both valid and relevant to be considered competent. So this may have a chance of being the correct answer. So let's leave it there. Okay, possibly a correct answer. Letter C, oral representations made by management are not valid. This is not true. Okay, oral representations made by management are still part of our audit evidence. Only that we are not to take them at face value. We always try to corroborate, but it doesn't mean that they are not valid. They are still valid. Letter D, evidential matter gathered by an auditor from outside a client is reliable. And maybe to this we get to recall the hierarchy of evidence reliability, where we said externally generated evidence or externally sourced evidence is more reliable than internally generated evidence. However, there is a certain qualification to that statement. Just because it comes from outside a client, it doesn't automatically make it reliable. Because can you imagine if it came from a source outside of the client, but then the source is not occupying the proper position, right? Or does not necessarily have access to the data needed to enable him to confirm or refute the said assertions, for example. And so in this case, while it may be true, this is not always true. So the correct answer then is bravo. This is always true. Evidence must be both valid and relevant. Next, what is the primary advantage of using systematic selection? And this has something to do with audit sampling. To this, we do recall the many different sample selection techniques. The most popular, of course, is random selection, where each item in the population has a chance of being selected. The thing with random selection is that since we will be drawing out random numbers, then it would be better and actually efficient if the sampling units are also arranged in a certain logical order, right? Otherwise, it will be very difficult for you to find the unit that corresponds to the random number. So this is actually one of the limitations of random sampling. Therefore, in order to address that limitation, we now have what is called systematic selection. The beauty of systematic selection is that the auditor computes an interval or a sampling interval and chooses every nth item. When we say every nth item, this refers to the interval, of course, then the auditor can actually make use of even the physical arrangement. So even when the units are not logically arranged, the auditor can still use systematic selection because the auditor can use the physical arrangement of the said sampling units to come up with a sample. So here are our choices. What is the primary advantage of such a selection technique? Letter A, they do not have to be pre-numbered to use the method because you can use the physical arrangement. Letter B, containing errors will automatically be included in the sample. Actually, there is no sample selection technique that can automatically include the errors, so it's not B. May be included more than once in a sample, and while this may have something to do with sampling with replacement and sampling without replacement, letter C is not a specific identifier. It's not specifically identified with systematic selection, so it's not letter C either. Letter D may be arranged in a systematic order, which makes a sample more representative of the population. Actually, friends, letter D is a disadvantage of systematic selection because if the sampling units are already arranged in a systematic order, this may destroy the possible representativeness of your population. If you can imagine, for example, a classroom setup where the teacher says that every person who is seated in the aisle or at the end of each row, for example, is a male. And so, therefore, if you use systematic selection and it would end up that every fifth person or every fifth item is a male, you will come up with a sample that is all males because the population is already arranged that way, right? So letter D is actually a disadvantage rather than an advantage. So the primary advantage is that they do not have to be pre-numbered. Physical arrangement is already enough for you to use systematic selection. Next, the market for auditing services is driven by letter A, pronouncements issued by the Auditing Standards Board, letter B, a demand by external users of the financial statements, letter C, the regulations of the Securities and Exchange Commission, or letter D, Congress at the federal level and elected legislative bodies at the state level. Of course, we don't have in the Philippines, we don't have federal and state level. Okay, so what is driving the market for auditing services? It is of course a demand by external users. That is why we are called certified public accountants. So there is a demand by external users. So the answer here is bravo. The next question is which of the following is not a management assertion? So we have disclosure, allocation, completeness, and accuracy. Now, in order for us to evaluate our choices, let's pull out what are the categories of management assertions. Now, we know that there is a revised ISA 315 or PSA 315, that which became effective 2019 and was able to identify already two categories. We have balances and disclosures, transactions and disclosures. We have to mention that because in the past, there used to be three categories. We have balances, transactions, and then presentation and disclosure. But now, with our new ISA 315, disclosures have become an important component of the category of assertions. Okay, so for balances, we have completeness, classification, presentation, accuracy, valuation, allocation, rights and obligations, and of course, we have existence. In the case of transactions and related disclosures, we have completeness, classification, cutoff, accuracy, presentation, and of course, occurrence. Now, for this number, we do have to exercise a little bit of judgment, mainly because this question was framed in the old standards, in the old ISA 315. So there was yet no new category there. But if you're going to look at this from the new categories, then it would seem that the non-assertion here is the one on disclosure because it's part of the categories. However, there is a second possible answer. We all know completeness is a category, is an assertion. Accuracy is also an assertion, as it is present in both, and so therefore the second weakest answer here would have been allocation because allocation is only present in one but not in balances but not in transactions. Okay. But if we're going to take a look at the list based on the new PSA 315, it would appear not part of the list of assertions would be disclosure. So let's have this answer for this question. We're kind of like reframing it to the new set of standards that we have for assertions. Okay. So it's disclosure, but if this were framed in the old standards, then it would appear that even allocation may be a possible answer if we are using the old. But since we're already in the new, so yeah, letter A is the answer to this. Next, audit documentation, or what we call working papers, is least likely to include documentation showing how the letter A, engagement has been planned, letter B, client schedules were prepared, letter C, client system of internal control was reviewed and evaluated, or letter D, unusual auditing matters were resolved. So our working papers support the work that we have done. It contains PEC, the procedures performed, evidence obtained, and conclusions reached. What is not likely to be found there is how the client prepared their schedules, because that is part of the role of the client, that's the work of the client, so that will not be included in our working papers. Next, we go to information risk, and we know that information risk is one of the reasons why there is a need for an external FS audit. So, at the end of the day, what is information risk? That's the big question. Letter A, it is the risk that the information in the financial statements is materially misstated. Letter B, it's the company's cost of capital. Letter C, it is the risk of the client not being able to pay off a bank loan. Or letter D, the cost a company incurs to issue and service equity and debt. Now, information risk is the risk that the information that we receive may contain misstatements. And so, therefore, the answer to this is alpha. That is why we need an external FS audit, no, in order to manage information risk. Next, let's talk about materiality. So the Securities and Exchange Commission notes with respect to materiality that letter A, auditors should consider both the individual and aggregate impact, so not just the individual impact, but the totality of the impact of the misstatements in determining if they are material. Letter B, small misstatements, regardless of whether they are intentional or not, are considered immaterial. Letter C, quantitative considerations are more important than qualitative issues when considering misstatements. Or letter D, professional judgment should not be used in allocating the preliminary estimate to the account. So I think at this point we would be able to remove already choices C and D, right? Because we know that when we assess materiality, it has to be a balance of both qualitative and quantitative. And it's also not letter D because professional judgment is very much in play when the auditor decides on the materiality levels and even in allocating, no, the preliminary estimate to the accounts. So we are left with alpha and bravo. And the correct answer, of course, is alpha. Okay, auditors should consider both individual and aggregate impacts of the misstatement. It is not bravo because, as pointed out by letter C, we do not only focus on the quantitative, we also look at the qualitative aspects of the misstatement. Next, after gaining an understanding of a public company's internal control and arriving at an initial assessment of control risk at a low level. So let's take a look at this one. Control risk is at a low level. That means that the auditor intends to rely on the control. The design and the implementation seems to be okay. That's why the auditor had an initial assessment at a low level. What is the next step? Letter A, test the controls to be relied upon. Letter B, issue the opinion on internal controls. Letter C, consider the most appropriate substantive test to be performed. Or letter D, determine the timing of the substantive tests. Do take note that the low assessment of control risk is only the initial assessment. So once the initial assessment of the auditor for control risk is low or less than high or less than maximum, the auditor will then endeavor to perform test of controls. And the results of the test of controls will be the one to dictate the final assessment for control risk. And the final assessment will now be the one to dictate the substantive testing. So since we're still at the initial control risk assessment, we do first have to test the controls to determine if our first impression is indeed correct. So alpha. Next, which of the following is not one of our four transaction cycles? We have letter A, expenditure and disbursement, or sometimes called purchasing and disbursement, sometimes called as well purchase to pay cycle. So letter A is a cycle. Letter B is the conversion cycle or your warehousing or inventory and warehousing cycle. So it is a cycle. Revenue receipt or sales and collection cycle, then also called rather order to cash cycle. So this is also one of our transaction cycles. So the risk assessment is not part of the four transaction cycles. The fourth cycle could either be payroll, okay, if the company is labor intensive, then they may have a separate payroll cycle, or you may even have a financing investing cycle. Okay, so delta is the exception here. Then we go back to sampling, an underlying feature of random sampling. Random sampling, this is the gold standard, is that each letter A stratum of the accounting population is given equal representation in the sample. Letter B, item must be selected systematically. Letter C, item in the accounting population has an opportunity to be selected. Or letter D, item in the accounting population is randomly ordered. One beauty and strength of random sampling is that we are giving each item in the population a chance to be chosen. So the answer is Charlie. Next, the understanding with the client should include all of the following except. And when we talk about this understanding, we're actually referring to our preliminary engagement activities where we do have to strike an agreement with the client regards the engagement that we are about to enter with them. So this understanding will include all of the following except letter A, limitations of the engagement, particularly on the importance of what is a reasonable assurance, because sometimes our clients expect us to give absolute assurance, which is impossible, right? So, limitations of the engagement. Letter B, what are the responsibilities of management, including as well what are the responsibilities of the auditor. Letter C, the objective of the engagement. In the case, for example, of an audit, is to give an opinion on whether the financial statements are free from material misstatements. Or letter D, the type of opinion which will be issued, and this is the exception. When we reach an understanding with the client, we do not agree on the type of opinion to be issued. Okay? Because the type of opinion will have to depend on the evidence that we are going to or that we will be obtaining. So we do not agree with the client what opinion we will be giving them. Okay? So delta is the answer. And speaking of reaching an understanding with the client, we normally document this one by the use of engagement letters. Engagement letters, letter A, help to minimize understandings between or misunderstandings between the client and the auditor. Letter B contains management representations concerning waived adjusting journal entries, but engagement letters are entered into normally at the start of the engagement. Letter B already is more on the ending part of the audit. Are required to be in writing, but similar to our contracts. While it would be best practice to have it in writing, an agreement can be reached even through verbal or oral agreement, right? Or are signed by the client's legal counsel, also a no, because this will be signed by the appropriate level of management. So the answer here is letter A. Engagement letters help to minimize misunderstandings, as you will find in the engagement letter, among other things, the scope of the engagement, including the responsibilities of management, as well as the limitations of the engagement and reportorial requirements. So it does help minimize misunderstandings. So alpha for this number, and we are done with part one. Like 25 items went by in such a breeze, right? So congratulations for surviving round three, part one. Once you're ready, I'll see you in part two.